Hello and welcome. Today we're going to look at one of the most important and influential financial structures in the world, the U.S. stock market. This system plays a key role in the global economy and attracts millions of investors every day. We'll look at the basic principles of how it works, its historical stages of development, the key players, and the peculiarities of stock trading. Let's begin our journey into the world of finance. The history of the U.S. stock market. It all began in 1792 when a group of traders met on Wall Street in New York City and signed an agreement known as the Buttonwood Agreement. This document was the first official agreement to regulate the rules of securities trading. The agreement provided for the creation of an organized system for trading stocks and other securities, which helped to streamline the previously chaotic process of securities exchange. The Buttonwood Agreement served as the basis for the creation of the New York Stock Exchange, NYSE, which officially opened in May 1792. Originally, the exchange was a small marketplace where traders gathered to do business. However, as industry developed and more companies wanted to enter the market, the New York Stock Exchange began to grow and expand. By the end of the 19th century, the NYSE had become the largest and most prestigious exchange in the world. Its popularity was due to strict regulation and a high level of trust on the part of investors. The exchange became the place where deals were made with shares of the largest corporations of the time, such as Standard Oil, General Electric, and U.S. Steel. The 20th century brought a revolution to the industry with the introduction of computers and electronic trading systems. In 1971, the National Association of Securities Dealers, NASD, was founded, which later launched the NASDAQ Electronic Exchange. NASDAQ initially targeted high-tech companies and offered a new trading model based on electronic platforms. The internet and digital technology made trading on exchanges more accessible and faster. Electronic trading platforms allowed investors from all over the world to participate in real-time trading, leading to a significant increase in trading volumes and investment opportunities. Today, U.S. exchanges like the New York Stock Exchange and NASDAQ are undeniably the most important centers of the global economy. They play a key role in financing new projects, supporting innovation, and stimulating economic growth. Modern exchanges are equipped with the most advanced technologies, enabling them to efficiently handle huge volumes of data and transactions. Main participants in the stock market. There are many different participants in the stock market, each with its own unique function. Investors are the main drivers of the stock market. They invest their money in stocks, bonds, and other financial instruments with the goal of making a profit. Investors can be divided into two categories. Long-term investors. These are players who buy stocks with the intention of holding them for a long time, often years or decades. They believe in rising share prices and dividends. Short-term traders. These players seek to profit from small fluctuations in stock prices. They trade actively using a variety of strategies and analytical techniques. Brokers act as intermediaries between investors and the stock market. They execute client orders to buy and sell stocks, provide analytical services, and offer investment advice. Issuers are companies that issue stocks and bonds on the stock market. They do this to raise capital to expand their business, develop new products, or pay down debt. Issuers can be large corporations or startups. Financial markets are heavily regulated by government agencies to protect the interests of investors and to ensure fair and transparent trading. In the United States, the Securities and Exchange Commission, SEC, is the primary regulator. Its responsibilities include monitoring compliance with laws and regulations, ensuring transparency of information about companies whose shares are traded in the market, and investigating fraud and abuse. Analysts and consultants specialize in researching markets and making recommendations to investors. They study company financial reports, macroeconomic data, and market trends to predict future stock prices. Advisors help investors develop customized investment strategies. Market makers are professional market participants who keep stocks liquid by creating supply and demand. They take on the risk of buying and selling stocks, ensuring that trades can be executed quickly. Market makers profit from the difference between the buy and sell prices. Participants in the U.S. stock market form a complex and interconnected system that promotes the efficient allocation of capital and stimulates economic growth. Each player performs a unique function, and together they create the conditions for stable and sustainable development of the financial sector. How shares are traded. Stock trading is the process of buying and selling ownership interests in companies. Companies issue shares to raise capital, and investors buy these shares to make a profit. When an investor wants to buy stock, he or she contacts a broker who acts as an intermediary between the investor and the stock exchange. The broker takes the order to buy the stock and submits it to the stock exchange for execution. The process then proceeds as follows. The investor sends the order to his broker, specifying the number of shares he wants and the maximum price he is willing to pay. The broker transmits the order to the exchange, where it is matched with offers from sellers. Modern exchanges use electronic trading platforms that automatically match buy and sell orders. If a matching bid is found, the transaction is completed immediately. Once the transaction is complete, the shares are transferred to the investor and the cash is transferred to the seller. The modern stock market uses the most advanced technologies to ensure high speed and security of trading. All major exchanges operate on electronic platforms that process thousands of orders per second. Ultra-fast fiber optic networks and microwave communication channels are used to transmit data between market participants. Many trades are executed using algorithms that analyze the market and automatically make decisions to buy or sell stocks. Trading stocks on the stock exchange is a complex and multifaceted process that requires in-depth knowledge and understanding of the market. However, with the use of modern technology and tools, this process is becoming more accessible and efficient. Whether you are an experienced investor or just beginning your journey in the stock market, it is important to remember the need for careful analysis and planning. How the IPO of a new company takes place. An initial public offering, IPO, is the process by which a private company offers its shares to the public for the first time on a stock exchange. It is an important stage in the life of any company, allowing it to raise significant funds for further growth and expansion. The IPO process includes the following steps. Preparing for the IPO. The company selects an underwriter, an investment bank, to help it prepare to go public. The underwriter evaluates the company's value, prepares a prospectus, and conducts a marketing campaign. Stock valuation. The underwriter works with the company to determine the share price it will offer to investors. The price must be attractive to potential buyers, yet sufficient to raise the necessary amount of capital. SEC filing. The company files documents with the SEC to obtain approval for the IPO. These documents include financial statements, a business plan, and information about the company's management. Roadshow. Before a company starts selling shares, it organizes a presentation for potential investors, called a roadshow. During this presentation, the company's management talks about its business and future plans and answers questions from investors. Start of trading. After all the preparatory stages have been completed, the sale of shares on the stock exchange begins. On the first day of trading, the stock price may fluctuate significantly as investors evaluate the company's prospects. Post-sale support. After the IPO, the company continues to work with the underwriter, who helps manage the liquidity of the shares and interacts with investors. S&P 500 Stock Index. The Standard & Poor's 500 is a stock index of the 500 largest publicly traded companies in the United States. It was created in 1957 by Standard & Poor's and has since become one of the most popular and influential indicators of the health of the U.S. stock market. The companies in the S&P 500 index represent a wide variety of industries, including technology, healthcare, energy, financials, and consumer discretionary. They include giants such as Apple, Microsoft, Amazon, Google, and many others. The S&P 500 index is calculated based on the market capitalization of its constituent companies. Market capitalization is defined as the share price multiplied by the total number of shares outstanding. Thus, the weight of each company in the index depends on its size and influence in the market. The S&P 500 is an important benchmark for investors because it includes shares of the largest and most influential U.S. companies and is less volatile than individual stocks. Because the index includes companies from a variety of industries, it gives a good idea of the health of the U.S. economy as a whole. The index is used for a variety of purposes. Investors and analysts use the index to evaluate overall market dynamics and make investment decisions. Funds and money managers compare their results to the S&P 500 to gauge the effectiveness of their strategies. Changes in the index can signal the beginning or end of economic recessions. Risks and opportunities. Trading the stock market inevitably involves a number of risks that every investor needs to be aware of. Here are some of them. Price volatility. Stock prices can fluctuate dramatically based on news, economic data, and other factors. This creates uncertainty and potential losses for investors. Economic factors. Macroeconomic events such as recessions, inflation, or changes in interest rates can negatively affect stock prices. Political instability. Political decisions, sanctions, and conflicts can affect the market and lead to losses. Industry risks. Some industries may experience difficulties due to technological change, competition, or regulation. Liquidity. Lack of liquidity can make it difficult to sell shares at a favorable price, especially during periods of market stress. Despite the risks, the stock market offers many opportunities for those willing to learn, analyze, and make informed decisions. Here are some key benefits. Capital growth. Long-term investments in the stocks of successful companies can provide significant returns through price appreciation and dividends. Diversification. By investing in different assets and sectors, you can reduce your overall risk. Passive income. Dividend stocks provide regular income, which can be useful for retirement savings or other long-term goals. Participate in innovation. Buying shares in young and growing companies can offer the chance for significant capital appreciation in the future. Accessibility. With the development of internet technology and online brokers, stock trading has become accessible to millions of people around the world. To minimize the risks and maximize the opportunities of the stock market, investors can employ various strategies. Portfolio diversification. Spreading capital across different assets and sectors helps reduce overall risk. Fundamental analysis. Studying a company's financial statements and evaluating its prospects can help select the best investments. Technical analysis. Using charts and indicators to predict future price movements. Consulting with professionals. Consulting financial advisors and analysts can help you make more informed decisions. Examples of successful strategies. Let's look at some examples of successful investment strategies in the stock market. Long-term investing. Many investors prefer to buy shares of promising companies and hold them for a long time, waiting for their value to rise. This approach requires patience but can yield significant returns. Trading. Active traders try to take advantage of short-term price changes. They use a variety of technical and fundamental analyses to predict market movements and make quick trades. Diversify. Spreading capital across different assets reduces the risk of loss. For example, you might invest some of your capital in stocks, some in bonds, and some in real estate or gold. Each of these strategies has its advantages and disadvantages. Choosing the right approach depends on your goals, level of experience, and risk tolerance. The key is to analyze the market thoroughly and make well-considered decisions. We have covered the most important aspects of the U.S. stock market, from its history to modern trading methods. It is a complex and dynamic system that requires attention and knowledge to participate successfully. But with the right approach, investing in stocks can become a reliable source of income and financial independence. Trading on the stock market is both a challenge and an opportunity. Understanding the risks and using the tools and strategies available can lead to success and financial stability. It is important to remember that investing takes time, patience, and constant learning. Thank you for your attention, and see you soon in the world of finance.